welcome to the Mortgage Rate Weekly Market Update for the week of March 13th, 2017. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week was not good to mortgage rates. Mortgage rates did spike higher, move to the highest they'd been in the last 3 years, as you saw back in December. So if you take a look at the bond chart on the screen, you can see mortgage bonds on Friday ended all the way back where they were in mid-December, which was the lowest point in mortgage bonds in a long time and the highest rates we've seen in a very long time. Now what happened was on Monday, we were starting the week floating, hoping that this line of support could hold right there and mortgage bonds could rally higher. But after the release of a very good ADP report on Wednesday, mortgage bonds just sold off again on Thursday, dropped all the way down to the lows not seen since mid-December. Now, the silver lining is that big line of support right there that goes back to December. That held on Friday, and the green candle there, we're able to bounce higher off of that. So what we're hoping is we can have another rally off that support. Mortgage bonds could continue to move higher. So we are going to recommend cautiously floating your interest rate to start the week. But again, if it reverses and we break below that support, that would be very bad news. We would see another record high set for mortgage rates as mortgage bonds break through that floor of support. Now, if they can rally higher and we can move back up, that'll be good news. So we are going to recommend cautiously floating. We'll see what happens. But big news on Wednesday, the 15th, the Federal Reserve Market Committee is meeting to discuss whether they're going to raise their Fed funds rate. Now, it's about an 88% chance they're going to. With a great jobs report, inflation's kicking up. They kind of almost have to raise the Fed funds rate. Now, the short-term knee-jerk reaction from the bond market could be to sell off, and that could move interest rates higher, which is what happened last December when they did it. But then, as you can see from the chart we had, mortgage bonds were able to reverse and rally off of that, and we saw interest rates move lower over time after the Fed funds rate hike. So we'll have to see how this plays out. Now, big economic news last week was the jobs report for February 2017. Came out at 235,000 jobs created, well above expectations of 188,000 jobs. The unemployment rate ticked down 0.1% to 4.7%, so that's very good news there. The labor force participation rate was the highest it's been in over a year at 63%. Now that measures the number of people 16 years and older that are actually eligible to work who are working. So as that number moves up, that means more people are entering the workforce. That is a good number there. And then we saw weak initial jobless claims come out on Thursday. Claims did jump higher, 20,000 claims to 243,000, which was above the expectation of 238. But still a very good report, well below the 300,000 mark. Weak initial jobless claims just still doing very good. So all this coupled together shows the U.S. economy has just started with a bang going into 2017. Stock market keeps setting all-time record highs above 20,000 on the Dow. So all of that is great economic news, great for your 401k, but it's not going to be good news for mortgage rates in the long term. So your best bet is to find a house, get under contract, lock your rate in when you can. But the long-term projection for housing is good. It looks like housing prices are going to continue up. Now, we saw that with CoreLogic releasing their home price index for January 2017. Showed home prices were up 6.9% from January 2016, and they're up 0.7% from December. CoreLogic is predicting home prices to rise on an average of 4.8% in 2017. So we're still looking for good home price appreciation. Great time to buy. You will make money on your investment over time. Now, in the local news, the next free first-time homebuyer seminar is Saturday, March 18th in Newark, Delaware, from 10 a.m. to noon at the Christiana Hilton Hotels. That's this Saturday. There's still a couple spots open, so go ahead and register for that. And then the next one in Dover is the following Saturday, March 25th, at the Dover Holiday Inn from 10 a.m. to noon. You can register for either one of those or give us a call in the office at 302-703-0727 or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.